Hello students, today we will study about capital market instruments. In this lecture, we will study definition and meaning of instrument of capital market, type of capital market instruments, equity share, preference share, debentures, bonds, difference between equity debt securities, conclusion, and finally the references. Introduction. The capital market is the market for securities where companies and the government can raise long term funds. It is a place where buyers and sellers of securities can enter into transactions to purchase and sell shares, bonds, and debentures. Basic capital market instruments. There are two types of capital market instruments. First, equity, and second, debt security. In equity securities, there are also two type equity securities: equity share and preference share. And in debt securities, there are two type of debt securities: debentures and bonds. Now we study about equity shares. According to the Companies Act 1956, equity shares are that part of the shares capital of the company which are not preference share. Very simple definition is given in Companies Act 1956 about equity shares. The shares which are not preference share, that are equity share. They are called as ordinary shares or common stock or voting shares because equity shareholders have right to vote for their share. These shareholders are the real owner of the company. The return on equity share depends on the performance profitability of the company. Merits of equity shares: a permanent source of finance to the company, no fixed rate of dividend, easy liquidity and marketability. Limitation of equity shares: no guarantee on return of shareholders. If company earn profit, then dividend will be given to equity shareholders, and if there is no profit, no dividend will be given to equity shareholders. So there is no guarantee of on return to shareholders. Loss of managerial control. Second type, preference share. Preference shares are known as preferred stock. Preference share capital has two priorities, that is, in the repayment of capital and payment of dividend. It means preference shareholder have two rights. They have preference in repayment of capital and payment of dividend. Preference stock usually carry no voting rights. Type of preference share: participating or non-participating, redeemable or irredeemable, cumulative or non-cumulative, convertible or non-convertible. Merits of preference share capital from company's point of view: hybrid security, absence of voting rights, no dilution of control, and fixed return. From investors' point of view: no secured, not an attractive investment, no right to participate in the management. These are the main limitation of preference shares. Debentures: when a corporation is in need of fund in addition to share capital, it borrows money by issuing debentures. The debenture holder gets interest which is fixed at the time of issue. Type of debentures: same as preference share, there are some type of debentures which are redeemable or irredeemable, convertible or non-convertible, secured or unsecured, bearer or registered. Merits of debentures: no loss of managerial control, a flexible source of finance, reduces burden of tax of the company. Limitation of debentures: fixed rate of interest, companies may have to mortgage their asset, not an attractive investment from company's point of view. Bonds are issued by public authorities, credit institutions, companies, and supranational institutions in the primary market. A bond is a negotiable certificate which entitles the holder of repayment of the principal sum plus interest. The most common process of issuing bond is through underwriting. Type of bonds: bearer bond, register bonds, callable bonds, convertible bonds, zero coupon bonds, fixed rate bonds. Difference between equity security and debt security. Equity security, owner of the company, while debt security is creator of the company. Equity security get dividend only when company earns sufficient profit. Debt security provides steady income to the investors. Equity security have voting rights, while debt security has no voting rights. Equity security are not secured, and debt security is secured in nature. Share capital of the company, which is equity security, and debt security, borrowed capital of the company. Conclusion: capital markets play an important role in ensuring the emergence of a vigorous and efficient economy. It facilitates the nationalization of an economy by linking it with the rest of the world. Thank you so much.